Hey guys, welcome to today's session. Uh, this is going to be a series. We'll be talking about a week of trading. So once in a while, we will introduce new strategies in the market that we can look at. So it's good to be diverse with some of these concepts. So today we'll be talking about Wyckoff and his approach to trading the market. So it's going to be very broad. Yeah, so it's going to be very broad. So I thought the best way will be we divide it into parts. First, we need to understand the fundamentals, the basics, that is, fundamentals means something else. And then from there, we can go uh, to the charts. So before I go on, just a minute. Let me just. Mhm. Yeah, so with me just 1 minute. Okay. Okay. Yeah. So Wyckoff. A lot of these concepts are going to be very familiar, relatable, because you can find these concepts in other styles of trading like smart money, uh, Dow theory, and all those. So it's not going to be very different, although it's going to be very unique. So the method was developed by a guy called Wyckoff from the name, and it relies on the premise that at the core of the market, we have supply and demand that influences prices. And these factors can be leveraged to identify patterns. So basically, we are still looking at the same things, but there's a small twist in it. So this system includes a relationship between price and volume, the identification of market structure, and the role that liquidity plays in the financial markets. Now, I've highlighted price and volume because not many people look at price and volume together. So in most cases, you just look at price, and then if you are still trading, then you might also look at time, but not many people look at volume. So one of the way you look at markets is there are three primary sources of data, or there are three primary data points. The first one is time, the second one is price, and the third one is volume. Yeah. All the other information you get from charting, especially, is usually a derivative of any of those. If I'm using a moving average indicator, that's derived from price. If I'm doing London open sessions, I'm basically using time to interpret that. Very many people ignore volume, and that's where Wyckoff has a very interesting twist to these other concepts, which is you can look at the relationship not only between price and time, but price and volume, because volume is still a primary data source from the market. Okay. Uh, then for most guys, when you talk about week off, we just know about accumulation, an uptrend, distribution, and a downtrend. But we are going to talk about that in other parts. For now, we are going to start with um, just identifying or the basics, which is supply and demand. So, okay, so what influences price change in the market? So once you know the fundamental way price behaves, then now we can start including volume. Then now we can start including these other concepts on top. Yeah. And at the core of it, supply and demand explains price changes. Yeah. At the core of it, you're basically looking at what a buyer is doing and what a seller is doing. So we're going to try and explain that in this session, and then we'll have another part. So this video is written part one. I think we'll have 5 or 6 parts so that you can follow clearly. If you are to do it in one video, it will have been either very compressed or very long, that will make you lose concentration. Okay, now let's look at a typical visual representation of demand and supply, and then we can talk about the two together. So um, if you are to visually represent demand and supply, a demand curve in economics is usually a downward sloping line that shows the willingness of buyers as they interact with the price. So if you look at this curve, you can see that the more price goes down, the more quantity, the more the quantity. That means buyers are usually willing to buy more if prices go down. So at this point here, probably the quantity is very few people are willing to buy. When the price reduces a bit, you can find that there are more guys willing to buy more of the goods. So usually, if you plot a curve of the willingness of buyers to purchase something, it's usually downward sloping. Why? Because as price reduces, more people are willing to buy in terms of quantity. So that's the first thing you need to understand, that the more price goes down, the more guys are willing to purchase. Supply, on the other hand, is the opposite, and that is a supply curve is an upward sloping line reflecting the willingness of producers or sellers to basically post their good for sale. Yeah, and this one is now the opposite. The more price increases, the more people are willing to sell, or the more sellers are willing to sell. Hence, the quantity increases as price increase. So, if you have to plot quantity against price, yeah, you will see that as quantity increases, as price increases, quantity increases. That means if I'm a seller, I'd want to sell more at higher prices. If the price goes down, I don't want to sell. And that's why at this point here, a low price, less quantity, higher price, more quantity. Yeah. Hope that is very clear. Now, there's an interaction. The concept of equilibrium is when buyers and sellers have agreed at a certain price. Yeah, so these concepts look very unrelated to the charts, but things can get complicated very fast. So it's very, you need to have a very rudimentary understanding of interaction between buyers and sellers and how it influences price. So the point where buyers are willing to buy and sellers are willing to sell is called equilibrium, and that's where the market price is. Yeah, this is, yeah, so the point where you have buyers agreeing on a certain price and sellers on the same point, same quantity, that's where the market price is formed, and that is called equilibrium. The interplay between supply and demand determines the market equilibrium. This is the price at which buyers and sellers agree and the market is in balance. And you will see instances of this on the chart. Yeah. Okay, moving on. Assuming there is some news regarding the asset that makes it more attractive, buyers will be willing to get more of the good at every price level. Hence, the demand curve shifts. Yeah. So assuming I'm a buyer, maybe I have a very low price over here, and this is the quantity I want. And maybe there's some news, let's say it's a market for pineapples. And yeah, there's some news that pineapple makes people healthy. I'll be willing to purchase more at a higher price, the same pineapple, and hence the demand curve. So at every point on the curve, we have more willingness by buyers to purchase. So that means generally the curve shifts upwards. Just a minute. The curve shifts upwards to reflect that new willingness. And when the curve shifts upwards, prices increase. Now the new price level is at this point here. Yeah. And it can be vice versa. If the thing becomes less attractive, then the curve shifts downwards. And that means in this case, the price drops. So you can replay this up to this point. It really explains or gives a very good picture of what price change is all about. The interaction between, again, we've said here, interaction between supply and demand. That is, if there is more being supplied, usually or sellers are seeking higher prices for it to be very attractive to sell. Even in any market, if you see a situation where the price of something you wanted has dropped, then all of a sudden you want to get that or purchase that item. Chances are there are more people thinking the same. So when the price of something drops, more people are willing to buy it. And now that we understand price interaction, we still have another chart to look at, and this is the order book chart. I think we can look at it once we introduce volume. But at the moment, this is enough to get us to the next section, which is defining the key concepts behind Wyckoff. And the first one is accumulation, which is buyers accumulate sell orders until there is little supply left in the market. So the market will start in a state of equilibrium or balance. That is, you have a point where roughly buyers and sellers have agreed on a price. Yeah. But if something happens and buyers start becoming more interested, or there's intention in the market to acquire the item more, that means gradually buyers will start overwhelming sellers. Yeah. And when buyers overwhelm sellers, it gets to the point where the market is no longer at equilibrium because there is nobody to take the other side of the trade, which is the sell position. And if that happens, prices start moving slowly upwards, and we have this shift that you are talking about over here. So buyers accumulate sell orders until there is little supply left in the market. The state of balance in the market eventually shifts to the path of least resistance. So prices are always trying to find equilibrium. And when there is no equilibrium, prices move to the point where there is equilibrium. Yeah, so accumulation is when that gradual imbalance starts being created. And then we eventually see an uptrend. An uptrend basically is caused by an imbalance between buyers and sellers where buyers are more. Yeah, so as long as there are more buyers than sellers, the price will keep on going upwards, and that's an uptrend. Yeah, and as long as the buyers are willing to also keep on buying. When the prices go too high, remember our demand curve, when the prices are too high, then less people become willing to buy. And now distribution happens. Distribution is simply sellers gradually come back in the market because now it's more attractive to sell at higher prices until eventually we have more sellers than buyers. Yeah. So distribution is that point of imbalance again, where we are seeing that sellers are gradually overpowering buyers. And once that happens, price starts moving in the path of least resistance, which is a downtrend. Now, a downtrend occurs when sellers have supplied the market until the path of least resistance is downward. So let's just have a look at this on the charts, and then we see how we can go from there. So just a minute, I need to open the charts. Okay. So we are still at a very fundamental level with Wyckoff, so we're not going to belabor so much points. Going to do this for now. We're going to start from this side. Actually, you can do the daily. Yeah, so let's look for a clear level to use for this. Okay, so there are usually exceptions to these rules, but in most instances, it's usually the the basis of the whole thinking or the whole methodology usually applies, apart from a few instances where we have an instant reversal in the market. But have a look at this over here. Uh, that's one point we can start with. So this is GBP USD daily chart. Maybe I can try use the 4-hour chart to make the point. Yeah, so we have this period over here where the market is in a sideways motion. That is, we've come from a downwards trend, and we've gotten to a point where we're no longer able to make lows, and hence we're just moving sideways. Now, this is a stage of accumulation, and we'll have more advanced topics with regards to the specific swings and what a swing outside the range means, and things like that. But just to simplify things, the market moves from a state of accumulation. This can be called accumulation, where the market is just consolidating until eventually buyers become more than sellers. And once that happens, for example, at this point here, then you can say that at this point, then there are more buyers than sellers, and the path of least resistance is to go up. And in this case, we had this upward swing until this point over here. Now I can zoom into this. This is a double top over here. So in most cases, you can find that after the trend has moved upwards for a significant amount of time, nobody is willing to continue buying the market, and that's when we start seeing distribution, which in this case hasn't happened for long because this still looks like a double top. So let me find an instance of distribution that we can use. Just a minute. Yeah. So when the market consolidates for some time, usually it happens because, yes, we've had buying power, guys buying for some time, but then buyers are no longer willing to take higher prices. And in this case, you can also tell from the sizes of the candles. But we will look at how you can interpret volume, what's happening in terms of buyers and sellers with the range of the candles that you are seeing to know whether this trend is going to continue higher or it's going to make a reversal. And that's where the whole Wyckoff methodology gets really interesting. But for now, there are phases in the market that involve accumulation, distribution, and accumulation, uptrend, distribution, downtrend. So let me just get a clear demonstration for that. Oh, you can use just a minute. I think I know what to do. Okay. So this is going to be a very textbook example before we get. So we'll have the market consolidating. That's the accumulation first. And then eventually it breaks into an uptrend up to the point where buyers are no longer willing to take higher prices. And at that point, we start having sellers come back into the market. That's called distribution. And then a downtrend like that, back to an accumulation phase as such. Yeah. So this over here, so here's distribution. Then we have this over here being accumulation. Then is an uptrend. Finally, downtrend. Yep. Yeah, so just have a look at this chart over here again and what we were talking about. The more price, or the more the price drops, the more something becomes attractive and more people are willing to buy. There is a larger quantity at a very low price level and a small quantity at a high price level. So as prices go down, buyers become more willing to buy. And as prices go up, sellers become more willing to sell. Now that's a dynamic that is in every market. And that's the same thing we're trying to put out to integrate on this uh, section over here, which is the market will accumulate at some point. When there is more interest with buyers to come in, then they're eventually going to overwhelm sellers. And that means if more people are willing to come into the market, then eventually the prices start rising. Why? Because the path of least resistance for price is upwards. Why? Because if I am trying to buy and I'm not seeing someone who's going to sell it to me, I'm going to bid at a higher price. And if I'm still not finding someone, I'm going to again ask for offer a higher price for whatever I'm looking for, until eventually I'm no longer willing to offer higher prices. And that's when we start seeing distribution. Yeah, distribution simply means buyers' willingness to continue buying has reduced. Now we're going to use volume and price action, a combination of volume and price action to deduce when distributions are occurring and when it's just a pullback and things like that. That's what we're going to look at in the next part of this session. But for now, just understanding the basic concept, which is accumulation, uptrend, distribution, downtrend, and how buyers and sellers interact in that whole movement is good enough. So again, thanks for attending this session. We will have a part 2 where we continue with this discussion for Wyckoff, and price action. So it's going to involve supply demand. We're going to have volume analysis, volume spread analysis. We're going to get into concepts like effort and action and things like that. So understanding the basics first is very important, and then we'll get to a part 2 of this video. So having said that, thanks for attending today's session. It was very short, but it basically has the fundamental concepts grounded so that then we can move on from there. So in the next session, when we start talking about the order book, which is what we'll be looking at, it's much more easier to relate to what we are saying here. Okay, having said that, thanks for attending the session. See you in the next session. Are there any questions from the chat section at the moment? Is it possible the topics could be announced earlier so that can do personal research? Yeah. So this one, I think preparations were, yeah. Usually we have the reminders set on YouTube. I think you just need to like make the reminder, but I'll try and make all the video sessions, the titles for the video sessions, so that they just get up on the channel so that you can set a reminder for it. Because the part 1 is just covering supply and demand. And then from there, we're going to go to volume and order book analysis and volume spread analysis. And then you're going to now incorporate market price actions and the other concepts going forward. So yeah, we'll try and list all the topics on the YouTube. Okay, JSquad, I think I've answered that. We have a market snapshot tomorrow with Rufus, and then on Friday we'll be looking at FOMC today. I know there's FOMC that's coming up in a few minutes, so we'll have some time to cover that tomorrow and on Friday. Hopefully, you're going to know if the trend for the dollar is going to continue higher or if you're going to see a reversal as is. Anyways, thanks for attending. See you in the next session. How can you understand Wyckoff? We've just introduced it. At the moment, just understand supply and demand, what we've discussed. So you can just rewind the video and just see supply and demand. Are you able to understand the basic principles, accumulation, distribution, uptrend, downtrend? Then you're going to go much in depth with it from there. So at the moment, just focus on understanding supply and demand and how that interaction helps in the market. For MC, last meeting caused an uptrend in or a downtrend in DXY. So going by the look of things, you can request for the PDF maybe on the socials so that I can be able to send it to you, because I don't know how to send it directly from YouTube. So just go to either Twitter or Instagram, any of the socials, or even the official contact on the website, and then just request for the PDF for Wyckoff, or just ask someone. Yeah, from the socials, it will be easy. Yeah, just request for it or ask for your account manager to ask for it from me. I think that will be easy to share it with, either from the socials or just ask your account manager. Okay. For MC, yeah, so last for MC was we witnessed a change in sentiment. If that continues, then we might continue seeing a weaker dollar. If they say something different, then things are going to change, and we might see a retracement in DXY. Okay, I think that's it for the day. Have yourself a very good evening.